Okay, well, thanks for joining us. So what we'll talk about today is the perspective of selling a company from the seller side. So Wayne's background, he's CFO at Solidaeus. Prior to that was the Chief Financial Officer at Pusher, and worked that company through a sale successfully. So we'll talk about his experience doing that, and what he learned, and tips that he would have if you're thinking about doing that. And then Sean, as head of Europe at AGC Partners, they're a tech-focused investment bank. If you look at the leaderboard of tech transactions, they're going to be right up there with all the bulge bracket firms. So he is, for me, a first call when one of our portfolio companies is thinking about making, putting themselves up for sale, or get some kind of inbound offer. Sean's someone that I trust to work with them on that. And he'll give the perspective of like a capital markets update. So you'll see some of this as a preview. Don't pay attention to that. Pay attention to these guys first. He'll give a capital markets update, so what's happening in the markets currently, but also talk about things that companies should consider when they're putting themselves up for sale, and the kind of metrics that you want to have, and how you can most successfully navigate through that. And then what we'll try to do is then bring those ideas together and talk about things that you should consider to help you maximize your success in going through a sale. So, Wayne, can you start off and tell us a bit about Pusher and what the company did, and maybe some use cases of how customers would have used it, or how the people in the audience may have come across Pusher?
Yeah, sure. Hi, everybody. So, yeah, Pusher is a business that's in the developer tool space, and provides sort of a real-time APIs for developers to use in their applications. So it's about being able to provide users of, let's say, a website like the New York Times, real-time updates without having to consistently refresh their page. So it's just, if you're looking at the US elections, for instance, you're waiting to see who's won whichever state. You don't have to keep refreshing. It's just continually happening, lots of concurrent connections, messages, and that was the primary product of Pusher. Yeah,
that's a busy night at Pusher headquarters.
Exactly.
Okay. So the company raised money from VCs, expanded into the States.
Correct.
Tell us a little bit about that journey, and then when you decided it was time to think about selling the company, how you came to that decision.
Yeah,
so a little bit about the journey leading up to that.
Yeah, so I joined just after they secured their Series A funding. They secured that funding primarily for a US expansion, like lots of tech companies do.
Sure.
And actually also to try and develop an enterprise sale motion. The business was very much a marketing-led, product-led go-to-market, right. And the money was there to sort of back an enterprise motion, primarily trying to crack the US, because the organization had many companies in the US as right. clients anyway. Okay. And I remember back in the day, I think we talked about this yesterday, when yeah. My first ever board meeting, and the founder being told that he's not spending the money quickly enough, right. And which was quite a shock to the system from someone from my background at the time. And roll forward sort of 6 months, 9 months, lo and behold, that enterprise motion wasn't really working, and we were burning heavily every month. Right. So we got to a point of sort of jumping ahead where fundamentally the decision was made that we would look to sell the organisation. We'd right. had a failed Series B attempt of funding. Right. There wasn't really particularly many VCs that were interested. That's because our metrics just were not in the right place.
Okay, right.
And just there wasn't one thing that led to the sale. It was a right. number of factors. So obviously the realization that we hadn't necessarily cracked the US and it wasn't going to work right. in that enterprise motion. The burn and the runway was right. it was tricky, starting to become tricky. I think the business had been going for a number of years, and I think the founder was actually getting slightly tired. Sure. And which is natural. I think he had a young family. He was thinking about his exit. Right. And so I think those I think there was another interesting dynamic in that the founder was very comfortable operating in a business of sort of 20 people, 25 people, where he could get his message across individually to people about his product vision and so forth. And I think we brought in a senior leadership team.
Right.
The business became sort of 120 odd people.
Oh, wow. Okay.
And I think that was quite tricky because he couldn't quite get his message across to the senior leadership team about how he particularly saw the product developing.
Right.
So I think all of those factors combined, and I think the other thing was that I've been around a long time, and I've seen in other businesses, founders or owners have opportunity to sell their organisation, their business, and they wait.
Right.
They get a little bit greedy, or think, no, this is not the right time. I can do better.
Right.
And I sort of told him about a few of those stories.
Right.
And I think all in all, that became there wasn't one reason, but a number of reasons why we decided it was time to see if we could sell the organisation.
And what kind of time frame was this?
So
2019?
Yeah, so back end of last quarter of 2019 calendar year, we made the decision that we would appoint an investment banker and sort of go out to market.
Okay.
Yeah.
Okay.
Yeah.
And so you've got this larger burn than you wanted to have. You've got someone hired to help get the company to a sale.
Yeah.
Maybe tell the group about how you squared those things. How did you present the company with this burn where the metrics aren't where you want them to be? Yeah,
it was quite tricky at times. I think the first things first is we appointed the investment banker, but actually take a step back. We had to persuade the board that it was time because not everybody on the board was ready to sell. Let's put it that way. Once we got over that hurdle, then we had the decision about the investment banker. The investors themselves would have had their own choices. Right. But we ended up. They supported the decision that we made.
So they wanted somebody in management team, wanted somebody else?
They probably wanted a more what you might call a more well-known name, a tier one investment bank.
Yeah, right.
I think what we realised was that we didn't have tier one metrics.
Right.
So we're not going to be particularly attractive to those tier one investment banks at the enterprise value that we were looking for.
Sure.
So we selected the investment banker, and then pretty much through December we were preparing the investor deck. Okay. Yeah, the presentation, and then the investment banker would then identify targets for us. Work them, and then through sort of Feb of 2020, I think we did 20 presentations. Okay, right. Interestingly, not face to face. This was all online, all via Zoom. So
this is before March of 2020 when everybody went Zoom. It was a little bit early.
This is before, yeah. We went through that cycle. After those meetings, there would be some follow-up questions, maybe some more information that was required, and then we moved steadily towards a decision around letters of intent at the sort of middle of March of 2020. Yeah.
And what kind of feedback were you getting from the buyer group? So you had 20 presentations.
Yeah. Very interested in the product. Yeah. Very much so. Interested in the story. Right. Were concerned about the burn. Versus the growth percentages. Were concerned about churn and contraction in the organisation, because if we roll back, the sales team in the US had signed some enterprise deals, but had probably oversold those deals. So come on another 12 months, people are looking to either contract or churn. So it was, but all of these potential buyers were well aware of our metrics prior to us presenting and where we were at. I think the investment banker did a very good job in sort of managing the expectations and working with potential buyers that understood the situation, that they had worked with before, and knew that if you got them to a letter of intent, they're not going to ding you on in due diligence and start trying to knock down price or walk away. So yeah, that's That's how we worked. Yeah.
Okay. Okay. So then you get to the letters of intent, and then what happens?
So let's say we had a couple of those. We sat down with the board. You make your choice. You give the exclusivity to the potential buyer.
Right.
Opened up the full data room for due diligence.
Sure.
Had that all prepared, and then bang, COVID hit.
Sure.
And that really that stopped the process. In that, the private equity house wanted to continue,
Right.
but they were going to be backing the business into another organisation.
Okay. Right.
And they felt underprepared to be able to integrate us into their
Sure.
organisation
Right.
through COVID. So effectively, we stopped.
Right.
We were already on our journey towards profitability, if you like. We'd made some
Okay.
cost savings.
I
We
see.
continued those.
Okay.
And through then from sort of March, April, May, June, we continued to trade. We moved from sort of loss-making to EBITDA neutral, and then into a small EBITDA, positivity.
Right.
And then, and interestingly, COVID worked for Pusher at the time, so our growth rate started to increase.
Okay. Right.
So we were growing less than double digits. Through COVID, we actually started to grow into that to 20 to 30% growth range. Yeah. So we continued to trade. We were profitable, so we were under our own steam.
Right.
And then in August, jumping forward again, of 2020, we decided we would go back out to the market. Now, that's not the norm if you've had a deal that's fallen over, but fundamentally, it was because of COVID that
Sure.
it didn't happen. And then when we went back out to the market, the strategic acquirers were much more interested in us.
Okay.
Primarily because of the burn.
Okay.
We were not a burning organisation. We had decent growth, not stellar growth, but
Right.
decent growth. And suddenly there was a lot more interest in the organisation.
Right.
It was quite interesting.
So first time you go out, company's burning, metrics aren't where you want them to be. Interest comes from private equity houses that
Correct. yeah.
take the company, put it into a larger organization, probably has clients in distribution, and they're used to reducing costs and
Yeah.
turning that around. So more comfort, I guess, with the burn, whereas the strategics at that time, not
No,
going to take
didn't wanna
that
know.
on. But
Just
once you're, as you say, under your own steam, the strategics much more open to that because
Absolutely.
they don't have to invest a bunch and worry about
No,
changing things.
Exactly,
Yeah.
exactly. So, so we went back out to the market. A much smaller group of potential
Right.
buyers this time, and fortunately for us, we had 2 or 3 letters of intent, and we quickly moved. I think the final letters of intent were in the end of October.
Right.
No, so the end of September.
Right.
We did due diligence in 4 weeks, and the deal was done in November.
Right.
So yeah, it was quite basically sold it twice.
Sold it twice.
So lots of grey hairs by the end of it.
Right.
Yeah. Yeah.
Right.
Yeah.
Okay.
Yeah.
Well, thank you. Sean, can you give us an update on, let's talk about what the capital markets are saying now, maybe weave in a little bit of the experience that Wayne had.
Yeah, absolutely. So it's obviously for tech been a great 2+ decades coming off of dot-com bubble, early 2000s. And more than any period in that time, the last 5 years has been a complete roller coaster. I think companies and investors are all trying to figure out exactly what's happening in the market. So where I'll start is just kind of where the capital markets are and what's sort of at least happening, and then try to at least provide my perspectives on why, what's driving this. And so if we start with just M&A and M&A value, it's way down off of obviously our bubble in 2021, but it's also down if you just look at 2017 to 19. So value has come way off. It's about 30% down on, let's say, 17 to 19 is our last time of normalcy in the market. And then you look at volume, and volume actually has held up pretty well. It's grown post-COVID, post-bubble, and so volume has gone way up. And so you're looking at sort of what's going on. Is it a good market? Is it a bad market? And I think there are a lot of differing perspectives on it, but the way I see it is, from a value perspective, what's happening is there are a lot less larger deals happening at a lot lower values, and more importantly, a lot of the small companies are consolidating because, just like Wayne's experience, they were in a burn state. Maybe they raised in pre-COVID or through the COVID bubble, but when the growth came out of the market, they didn't cut costs quickly enough. And so they ended up not as a distressed business. I call them more an end-of-life business where they need to find an outcome or home somewhere. So it's a good company, good product, probably fits within a larger organization, but they don't have the ability to either raise from their existing investors or fit the profile for new capital injection. So what we've seen on the volume side is, coming off the bubble, markets have crashed, is volume went up. And this is what I would call consolidation. So this is a type of transaction that isn't happening at the really high premium prices, tend to be smaller companies that didn't reach sort of that growth stage, more early stage. So it could be 30, 40 employees. So that's about the median in terms of the size of the business that's consolidating. And now that volume's come down slightly this year for the first time. So you're seeing some of that noise, if you will, in the market come out of the market. Some of that consolidation is coming back down, and so volume's normalizing. But we had this peak of transactions, just like we saw actually in 2008, 2009, when we had the recession, Great Recession. And that trend was very, very similar, where investors pulled back capital, were deploying at slower rates, and companies weren't able to react and right-size their cost structures quickly enough. And so it triggered a lot of M&A, but not necessarily the type of M&A you want to achieve as a business or as a founder or CEO. You want to be able to be the master of your own destiny, if you will, to be in control of that timeline to an exit, and to be able to react to changes in the market such as this quickly enough to make that possible. So on the M&A front in tech, it's really an ugly picture, I would say. Value being down off of a mark from 5, 6, 7 years ago is not a positive indicator for us. And I think when you look at the capital markets from an invested capital perspective, so these are minority rounds into businesses, it's a similar story. So you're looking at, if you compare it to 2019, invested capital was down this year versus 2019, and down over 50% compared to the bubble, which we all understand, there was a lot of money put into the market at that time. When you look at the volume, again, actually volume's not that bad, and there are different dynamics happening here. So when you look at volume, what's happened is the round sizes have come way down. So you're seeing a lot smaller financing, maybe with the exception of AI, where we've seen, the $1 billion plus rounds. So you've got kind of this mega AI market pushing some of that $200 billion of invested capital, but then everything else, you're looking at much more conservative capital deployment from investors. So it's obviously still a very active market with thousands of transactions happening, but ultimately, if you look at the health of the market, it's not as strong as it was probably in 2019. And for technology and for the only sectors that's shown really strong growth over 25 plus years, that's a bad indicator. But I think what's much more difficult to unpick here and describe is, why is this happening? When you look at the why, and people talk about capital markets, as I've just talked about here, and they talk about the capital, they talk about the value, they talk about the volume. But in reality, when I think of capital markets, there's really two sides to the market. So there's the capital side, which is everything we just described. And so if you look at that specifically, the capital that's being put into funds right now, even this year and over the last few years, is exceptionally high, right? So LPs, the people that invest in the funds that have put money into your business, the LPs have still significant demand for tech. And we're in right now, I think, the 4th largest fundraise year all time in technology. So the LP demand, the investor demand for tech returns is absolutely still there. It is consolidating around fewer fund managers. So what we're seeing is, if you look at the bubble, there were 169 new funds, whereas in this year there's 67. So they're consolidating around fewer funds, and so the funds themselves, if you look at the left side, are getting a lot bigger. But I think the main point for you as a founder or operator of a business is it's not really a capital problem at all. And so what is the part of the capital market that people don't talk about, and I believe is actually more important to the story than capital itself? And that is the growth in the market. So if you look at, there we go. If you look at what happened in 2021, yes, valuations were off the charts and way too high. These companies were clearly not worth anything close to what they were trading at, either in the private markets or public markets. But the other thing that was happening during COVID is these companies, like Wayne described, were actually growing extremely fast. So the median growth rate across 140 public companies that we track, the median growth rate was 31%. And these are businesses with $1 billion plus, some have $100 billion in revenue. 31% growth at that scale is exceptional. And so when you look at, well, what's happening now? Why are all of those charts I just showed down? The growth has completely come out of the market. All of that capital I described going in from LPs into these funds is all growth capital. They're all growth investors. They might be a large private equity house looking to buy companies on EBITDA, or a smaller growth equity, growth buyout firm that's looking to pay revenue multiples, but they're all pinning their investments around growth opportunities to 3, 5x these businesses over a course of 5 to 7 years. And so growth coming out of our market is going to bring it to a halt. It's going to cause all those charts to come down. And right now, I mean, we're not quite at the dot-com, we're not quite at the Great Recession numbers, but it's down to 13% in the public markets, that last filing that we've seen. So this is much more driven by IT spend within organizations and, quite frankly, consumer demand for their products and services. So we're looking at a much bigger sort of macroeconomic issue that's holding back our tech markets, not necessarily the lack of capital in the markets or the lack of good ideas and good companies and innovators and disruptors that are coming from our ecosystem. And so how have the big companies reacted to that? And similar to the story Wayne described, they're all growing earnings. So they've basically more than tripled their EBITDA profile in terms of the big public companies. So they've gone from like a 6% average EBITDA margin to 20% plus, and most of that sort of optimization is probably done now, but that's where they've gone to as big organizations. What can we do? We've got to grow bottom line versus top line. But ultimately, I think that the point that I try to make to my clients and prospects is our market, there's 2 pillars to it when you talk about capital markets. Of course, there's the capital side, but growth is the foundation of our markets, and it's what drives transactions, it's what drives valuations. And I think when you think about the one thing that is hard to control in an organization and the companies we work with, it's growth. So this is a fundamental issue that's not easy to solve. And when you look at, okay, well, we can't really control growth. Yes, we can spend more on S&M, but spending more, the next dollar in is typically less efficient than the previous one you spent. It's not an easy problem to solve. You have to look at other parts of the organization to fix this problem. So it might be retention of your existing clients and other mechanisms. But really, this is what I try to describe what's happening. And look, if you look at history, there's immediate bounce back in the Great Recession, dot-com. But right now, the broader macro environment, if you look at global GDP growth, it's 2% on 2% government deficit, right? So not to get into macro details, but the global economy is not growing, and where it is growing, it's pretty much driven by stimulus from the governments that we serve. So ultimately, where we are, I don't think that this is going to change quickly. I think every advisor and investor has predicted the next year will be kind of windfall rebound in tech M&A and tech investment. I do 100% believe that we are in the right place and that ultimately growth will come back and maybe normalize, not at 31%, but 20%, but it's likely going to be a slow return and acceleration in growth and new customer velocity. So when I look at trying to give the right advice in preparation for a transaction, I try to tell companies that, you know, they should be conservative in that outlook, and we'll talk a little bit more about that. But this is, you know, the reason why, you know, our capital markets today are where they are. And to sort of bring this into a conversation about, okay, well, what's the ideal outcome for you, and how do you think about the most likely acquirer or new investor? There's a couple dynamics at play. So I talked a little bit on the volume. There's this consolidation in the market. The other thing that's happened is the big tech players, and this is just a few examples, have completely pulled back, right? So Microsoft, you know, prior 2 years, so 18, 19, doing over 25 transactions. Now I think they've done 5. So, you know, the big tech have pulled way back on M&A. A lot of that also has to do with their focus on AI and internal development and some of where they're putting spend and investing in companies. But ultimately, that ideal outcome to, you know, Microsoft, we have all the synergies in the world with Microsoft. It's far less likely today, even if it was improbable before. Now it's in this case, you know, I just don't think it should be part of your decisioning. Of course, we can talk to them, but most likely it's not going to be the buyer that's going to, you know, pay 20x revenue and you get that iconic outcome. What's happening in our market is the PEs are becoming market makers. So the private equity firms, these are the firms that might own a platform business that's acquiring you, or they may do a platform deal with you if you fit the profile. So we compare here the top 135 public companies in tech and their M&A activity with the top 135 private equity-backed businesses. So these are, you know, 135 versus 135 quarterly transactions. So you can see that they're basically at a 4-to-1 cadence on deal volume. So when you say just high level, who's the most likely buyer for our business, or type of buyer, I should say, it's that private equity-backed platform or maybe private equity firm. So this begins to form your view on, well, how do we optimize that transaction? How do we think about building that profile for an exit? These are our market makers. And look, these players can pay they can pay that iconic outcome in some cases. So they're not bad buyers, but they do wear an investor hat, and you have to fit into their world and their box. And where you don't, you will see that your outcome is dinged significantly for it. So what's happening for those that don't fit that sort of perfect profile is the rise of the consolidators. So I think everybody knows Constellation, and they've got many, many different vehicles rolling up, a bunch of software companies. But now you have 50 of these vehicles, basically. And look, these, of course, are market makers for a certain profile of companies, and they're healthy to have in our ecosystem. But when you think about who's the best buyer for my business, you don't want to land in one of these organizations, and no offense to them, but they're just deep value-oriented acquirers. So they care a lot about certain things like retention, but everything else, all problems they can probably deal with at the right price. So they are driving tons of transactions in the market, and I think when you think about, you know, the tech titans, you know, are we going to sell to Microsoft versus PE-backed players versus consolidators, ultimately I think about it as Titans. Look, you can check, maybe there's a deal there, an iconic deal, but it's not probable. Whereas the PE-backed businesses, market makers, clearly the most probable type of buyer, and they can pay the big price on synergies. And then the consolidators, where look, you don't want to end up here. This is only if ultimately you're not able to address one of the previous two markets I described. So the rise of the consolidators, look, healthy for the ecosystem, and we appreciate their place in our market, but not the type of buyer. And I would assume that most of these have probably reached out to you in some way or another, and they are very salesy in their approaches, so they are nice, but they do need to sell them as the right home for your companies. And so this is a category that will always be there as a market backdrop, but not in terms of optimizing an outcome. So I think I'll just finish on what does all this mean from a valuation perspective? So from a value perspective, this is a revenue multiple chart. So what are the revenue multiples that we're seeing in the market, the public markets? And what's interesting is that the valuations in the last 3 years haven't really changed. I mean, it's the first time in tech where value has been really stable. It might be low relative to 17 to 19 and of course the bubble, but it's been basically the same for 3 years. So going back to thinking about an exit and are we going to wait the market out? Is it going to rebound? I mean, sure it could, but what we're seeing right now is it's actually underperforming the other sectors in the public markets, which have seen some growth in value this year. So it's been very stable, which at least gives you some stability and clarity on where things are going to potentially trade at certain with certain metrics. I always get the question on, is it growth, is it EBITDA, how do we balance this? And it's a fair question and a difficult one to answer, and I think if you asked 5 advisors, 10 advisors, you might get 5 to 10 different answers to the question. But the way I view it is that growth ultimately, if you look at the correlation between growth and value, is the biggest indicator of value. So if you look at public companies, there aren't that many that are growing at 25%. If they're growing at 25%, almost all of them are trading at 10x plus revenue. So the correlation is extremely strong to growth, and that is the primary driver of value. But then why are we talking about profitability and EBITDA and making sure the business isn't burning capital? The reason for that is there's a deep discount associated with inefficiency and the lack of profitability in this market. So if you look at the correlation between EBITDA margins and value, there isn't a very strong correlation. However, if you look at the correlation between Rule of 40 and value, which is the combination of growth and EBITDA margins, there's a very strong correlation. So the point is that, look, if you want to optimize the valuation of your business, growth is going to be that primary driver, but you have to check the box of efficiency. If you don't, you will get a heavy discount on the business. And so it doesn't need to be Rule of 40 necessarily, but you can see on the left side where businesses perform poorly on Rule of 40, there are significant discounts to where they trade in the market. So that's how I would describe it. You want to continue. Growth is the driver over capital markets, and growth is the single most important driver to valuation, but you can't be inefficient in this market. So you need to balance efficient growth with the highest growth rate that you can get. So that's how you check the box of efficiency and profitability. But at that level, it's about how fast you can grow. It's likely the driver of the outcome.
Great, and let's talk a bit. We've got about 5 minutes left. Let's talk about as the audiences goes back to the office and they look at their metrics, what things should they focus on? I think you've got a chart that shows a bunch of them, sort of good, better, best. What should they focus on? What are sort of the top ones that we look at?
Yeah, so firstly, I think it's important to score your business. So this is a very large, ugly score chart. It's an eyesore, but understanding how, examine your company and come up with your scorecard and come up with a score to it. But I think just for the purposes of today, I want to just key in on the ones that really what I call gating items. Are they going to be interested in the opportunity or not? So it's the gate that you can walk through, all right, you fit this private equity fund. And so the other ones are gaining items. They might push value up or down, but these ones are really, really important. So scale is something that you may not have control over today, but you do in a way because timing is going to determine, how big the company is. And so timing is a really critical point that you need to, one, get good advice on, but also when do you go to market and how do you think about timing of the transaction? So, if you're a 30 million revenue business or a 10 million revenue business or a 5 million revenue business, you have to critically think about timing relative to scale compared to the backdrop of our market where funds are bigger now than they were before. I think the other one is growth. I talked about, look, this is the one that's most difficult to control. So I don't necessarily have the answer for the operators, but knowing that growth isn't necessarily in your control, you have to think critically about things like EBITDA margins. So I talked about when you budget your business and you've got a business that's going from 20% to 40% next year, when I talk about cost budgeting, I usually tell them to cut the growth rate 50% when they are determining their cost base. Because if you don't hit the numbers, ultimately that path to profitability or that path to higher EBITDA margins, wherever you are in that journey, is going to take a lot longer because most tech businesses have very high margins. And so that the growth is actually the biggest determiner for where your cost base should be. So when you're doing the budget, I would think about sort of bringing down the growth 30 to 50% in how you determine how many heads you should add to the company and how you should, from a cost perspective, look at the next 12 months. Gross retention, this is the most critical driver of interest in our market. So everybody talks about mission critical software and mission critical solutions. When reality, look, you may be selling an ERP, might be mission critical, but in reality, there's a gray area. And so you hear these words like stickiness and how much is the customer reliance on it. And gross retention is basically a proxy for the mission critical solution. So now that's how the investors look at it. 95%, all right, it's mission critical, regardless of if it's MarTech or an ERP in the office of the CFO. So ultimately, the biggest two issues that I see in terms of the companies that have issues with gross retention are usually not understanding your ideal customer profile, like who you're selling to, and that's understandable. You're a growth business, you're selling to everybody. But that's usually one of the issues in terms of actually gross retention and poor gross retention. And the other one is adoption. So this is onboarding to usage understanding. And so when I look at how can we improve this, it's really understanding is the customer using it when they actually buy it, and what is that usage metrics, and what can you do when you're onboarding them to ensure that there's immediate usage of the product? Because in most cases, it's not actually mission critical. I mean, the customer can stop using the software and they'll still survive. And so that mission critical tag is kind of a myth for most companies. And so how do you make sure that it's sticky and it's used? And so gross retention, huge driver of value. Founders love to talk about net retention. In 21, it was a big point of emphasis. I think it's less so today, but they like to talk about it because it typically looks better than gross retention. But on the net retention side, I do think it's important to not have erosion in the base. So think about trying to get to 100% plus. So that's customer success, but I'll leave it there. I know I'm
Okay, I
talking
think
too
we've come,
much.
I think we've come to time, and like the last session that I was hosting, I promised I'd have time for questions at the end, and I've lied to you again, so I apologize for that. But John, Wayne, thank you very much. We'll be outside if anybody has any questions they want to follow up on later. Great. Thank you.